the direction of the economy in 2022. We need to remember back over 40 years, we've probably been in the most benign economic climate in human history. Declining real and nominal interest rates beginning in 1982 from admittedly a 17.5% prime. US dollar hegemony on a global basis. So as Americans, we could export our problems to other people. The demographic benefit of the baby boomers, which is of course over. The good and peaceful part of globalization and free trade. We're now in a much more mercantilistic economy. But I think of particular note has been what you describe, which is to say the increasing amount of debt and deficit relative to the private economy. Let's look at some arithmetic just for fun, Frank. If you measure the deterioration of the purchasing power of your dollar, which is to say your cost of living, by the CPI, you will believe that inflation is running at 2.6% a year. That varies pretty dramatically with what you're experiencing at home. The price of gasoline at the pump, the price of food. Notice that the CPI doesn't include food or fuel when it's inconvenient. An odd index for someone who either drives or eats. Notice, too, that the CPI doesn't include tax. Now, a cost of living index that doesn't include the largest component of most household expenses is fairly silly to me. I did a thought experiment over the last 4 years, and I attempted to measure, improperly and anecdotally, loss of purchasing power for my own savings and investment in the purchase of goods and services necessary to maintain my life. By the way, I don't describe taxes as a service, but that's a different, and they certainly aren't good, but let's leave them aside. I have to pay for them. And what I have discovered is that the purchasing power of my savings diminishes at about 7.5% compounded in US dollars. So that's an anecdotal number for me. That is to say, the decline in the purchasing power of my savings. The yield I get on my savings, the real yield, if you define them by the U.S. 10-year Treasury, the world's benchmark savings instrument, is 4.3. So I get paid 4.3 in a currency where my purchasing power is declining at 7.5. In other words, the value proposition associated with the world's foremost fiat currency is that you lose about 2.5% of your purchasing power a year, perhaps 3, compounded over 10 years. If anything at all would make me concerned about the efficacy of fiat-denominated savings products, it's a government-guaranteed loss. There are, of course, other things. There are other things that concern me. The predilection of the political class to deal with any economic circumstance through counterfeiting. They call it quantitative easing. From a saver's perspective, the printing of more specious currency units does not make every existing unit more valuable. It makes it less valuable. And then, of course, there's the credit quality. As you know, I'm an old credit analyst, and I look at the on-balance sheet liabilities of the United States government exceeding $34 trillion, or $28 trillion net of the Fed's own balance sheet, which is to say net of counterfeiting. And I look at the other side, at the net present value, not nominal value, but rather net present value of entitlements, Social Security, Medicare, Medicaid, federal pensions, military pensions, environmental trust funds, stuff like that, exceeding, by the estimate of the Congressional Budget Office, $100 trillion.
Rick Rule suggests that the economic outlook for 2022 needs to be understood in the context of the past 40 years. He points out that we've enjoyed a benign economic climate, with declining interest rates since 1982, and the US dollar's global dominance allowing the export of problems. However, the baby boomers' demographic benefit is over, and globalization has shifted towards a more mercantilistic economy. A major concern is the rising debt and deficit relative to the private economy. Rule highlights that the CPI suggests inflation is at 2.6% annually, but this doesn't reflect real experiences like gas and food prices, and it excludes taxes, which are significant household expenses. According to his own analysis, Rule estimates his savings purchasing power has been diminishing by about 7.5% annually, while the yield on US 10-year Treasury is only 4.3%, leading to a net annual loss of around 3%. He believes this highlights the flaws in fiat currency, where savers face a guaranteed loss. Rule criticizes the political tendency to address economic issues through quantitative easing, which he sees as counterfeiting, further devaluing existing currency units. As a former credit analyst, Rule is also worried about the U.S. government's credit quality, noting liabilities exceeding $34 trillion and entitlements surpassing $100 trillion in net present value, according to the Congressional Budget Office.
It's very difficult for me to understand why people wouldn't own physical gold unless they have access to investments that have built-in inflation hedges, which is to say owner-operated, moderately leveraged real estate where the operator has the ability to outcompete other folks.
Mhm.
I own gold personally, although a financial planner would tell me I didn't need to, given my large shareholdings in Sprott.
Mhm.
I own gold personally as insurance. I own it because it helps me sleep nights, which is a very good thing at 71 years of age. I don't own gold as a trader. I don't own gold because I think it's going to go from 2,400 to 2,700. I couldn't care less. I own gold because I'm afraid it's going to go to $9,000 or $10,000. That's why I own gold. And by the way, since beginning again to add to my physical stack in 1998, it's treated me very well. Eight and change compounded for an unloved asset is pretty good. Investors in gold stocks or speculators in gold stocks, two different breeds, must look at something very differently. I remember that you have a talent for technical analysis. If you look at gold market beta or gold equities beta, when we come into a period of a gold bull market, the simple beta, I would define beta as the delta between the performance of the gold equity sector and the broad equity sector, is spectacular when we come into a gold bull market. For those speculators seeking alpha, and I know you have a sense of humor for that too, which is to say individual small stocks where you take advantage of information asymmetry in the market, for those people willing to take the risk and do the work can be extraordinary. But I would argue that investors, when they seek to answer the question as to which asset class they might own, should look at themselves in the mirror. What type of investor are they? How much risk are they willing to assume? And most particularly, how much work are they willing to do? If their primary consideration is reading more books, doing more gardening, spending more time with their kids or grandchildren, then I think they need to own the physical gold. They need to own it as insurance. If they're willing to do some work, if they want to balance their equity portfolio, keeping in mind the beta in gold during a gold bull market, they should do some work, but you need to do just a little work and find the 4 or 5 or 6 best gold mining companies in the world. For those people who are seeking alpha, for those people who are attracted to 10 baggers or 20 baggers, please understand that you have to subject yourself to a lot of volatility and a lot of risk. And in order to do that, you have to commit to doing a lot of work. Frank, you may know that anybody who wants to can go to ruleinvestmentmedia.com and list their natural resource stocks. I personally will rank them 1 to 10, 1 being best, 10 being worst. As a consequence of that, I've ranked about 80,000 portfolios in the last decade. And the one particular lesson I've gotten from that is that most speculators own way too many stocks. And their technique for selecting them seems to have been got a hunch, bet a bunch. I would suggest that speculators limit the number of stocks they own that they want to work on their portfolio. And by working on portfolios, I don't mean listening to Rick Rule or Frank Curcio podcasts. I mean reading quarterly reports, reading balance sheets, reading resource statements, reading management information circulars, reading proxies. If you're willing to work 10 hours a month, you should consider owning 10 stocks. If you're willing to work 20 hours a month, you should consider owning 20 stocks. If you aren't willing to work, you shouldn't own any speculations whatsoever.
As we explore the value of gold and silver, it's important to understand different types of investors and their strategies. Knowing your investment style and risk tolerance is crucial for making informed decisions about adding precious metals to your portfolio. Investors in gold and silver fall into 3 categories: long-term holders who see these metals as economic safeguards, active traders seeking to profit from price changes, and speculators chasing high returns from smaller mining companies. Each approach requires different levels of commitment and understanding. For stability and minimal risk, owning physical gold and silver is best. Focus on acquiring coins and bars from reputable sources to hedge against economic downturns and inflation. Active investors and speculators aiming for higher returns need to research top gold and silver mining companies, mindful of the high volatility and risks of junior mining stocks. Managing investments effectively means keeping your portfolio to a manageable number of stocks. If you spend 10 hours a month on your portfolio, consider owning around 10 stocks. If you spend 20 hours, you might manage up to 20. Quality over quantity and staying informed is key. Price manipulation by large financial institutions keeps gold and silver prices low, creating opportunities for savvy investors. China's strategic gold accumulation shows how to bolster reserves without driving up global prices. Silver, often overshadowed by gold, has unique potential with its industrial applications in electronics, renewable energy, and medicine. The demand for silver, especially in solar panels, will rise as the world moves to renewable energy. To invest in gold and silver, you can choose between physical metals like coins and bars, which provide security but require storage and insurance, or paper gold and silver through ETFs, mining stocks, or mutual funds, which offer convenience and liquidity. A balanced strategy might involve a mix of both. Incorporating gold and silver into your portfolio offers protection and growth potential, hedging against inflation, currency devaluation, and economic uncertainty. These metals provide insurance for your wealth and opportunities for growth during economic downturns and high inflation. Diversifying with precious metals creates a more balanced and resilient investment strategy. On a lighter note, consider this tweet. Investing in fiat currencies is like putting your money in a leaky boat. Gold and silver are your lifeboats to financial freedom. And another, why did the investor buy gold and silver? Because even during a financial crisis, they wanted something shiny to hold on to.